In this video, a wide-ranging report from Coinbase Institutional. This is their outlook for 2023, but it also calls on a lot of the data that we've now got from 2022 in terms of the trends and where the market actually is and where they see the best investments over the next year. We'll go through the best points of this, and I'll leave timestamps in the description. Also check the links down there in the description to deposit and trading bonuses on Binance, BitGet, and others. They're also doing commission-free spot trading right now, so if you are an investor, get commission-free spot trading and then take that out to your wallet. There's really three main areas to this report. The first is crypto in general, and then you have Ethereum and smart contract-based chains, and then you have Bitcoin. We'll start off with kind of a note from them, which is looking at the Sharpe ratio of a Bitcoin ETH portfolio. Now, if you don't know what Sharpe ratio is, it's essentially a measure of risk-adjusted returns. I've actually got a video on this in the crypto course. I'll link it in the description. You can see this Sharpe ratio video. So it tells you this and other metrics that professionals will use to actually see what the risk-adjusted return of something is. And that's really important because if you're taking extra risk, you need to be compensated for that risk in terms of volatility and risk of loss. So what they actually see here, and they actually compare a Bitcoin ETH portfolio to stocks and gold and the NASDAQ and S&P, which is obviously a different exposure. From a Sharpe ratio perspective, crypto's risk-adjusted return actually performed in line with US and global stock indices throughout 2022 and did much better than US bonds. Prior to the fallout in November, an equally weighted basket of BTC and ETH, so 50-50 of each, offered a negative Sharpe ratio of 1.08 compared to an average negative return of 0.9 for US stocks. This is a significant deviation from the trend observed in the last crypto winter when digital assets underperformed nearly all traditional risk assets for the duration of 2019 and 2022. Here you can see the Sharpe ratio is actually, even despite coming down in price, both BTC and ETH, you can see it's actually outperformed on the Sharpe ratio, a few of the more traditional asset classes. Now, given that BTC and ETH are obviously way more volatile, you would expect them to come down more in bear markets, but also have that potential to go up way more in bull markets as well. Really interesting here is the correlation that Bitcoin and ETH have to traditional assets. Now, it's usually seen that Bitcoin is known as a uncorrelated asset, and its returns actually are very different to other traditional assets. And this is proven again this year. So as you can see right now, the high positive correlation between cryptos like BTC and ETH versus stocks had significant attention in 2022. There was a lot of correlation there in terms of when the Fed steps in the market, either to ease or to tighten, correlations, trend towards one, right? Everything goes down and up. And that's changing now. So I think we're in a process, and we've seen this from Bitcoin on-chain as well, that it looks like we're in a bottoming process. And so things may be starting to uncorrelate again. These things are very slow, but you can see that here. They exhibit a low correlation with other traditional financial assets, including commodities and bonds. And so if you do have those, if you have bonds, commodities, stocks, then buying Bitcoin will diversify you in terms of its correlations. So as you can see here, Bitcoin and ETH on the left-hand side, they're not really correlated in any way to other assets. They're very, very correlated to each other, 0.89 correlation. But to other assets, they do not have a very strong correlation, meaning this definitely can increase diversification in larger portfolios. Central banks are still in control of markets worldwide, and Coinbase agree with this. As you can see here, we assign a low probability to the chances of crypto performance decoupling from traditional risk assets. Central banks still have their arms around our necks, and that is not normal, right? And so 2023 is probably what people are looking for as a year just to kind of take a breath and actually find some sort of bottom. Definitely not some start of a new raging bull market. That's just not where anything is seen. Now, as you can see here, we expect digital asset selection will transition towards higher quality names like Bitcoin and ETH, and obviously some others. They're not going to name any names in terms of their competition though. Long-term holders of BTC at 85%. So you can see that long-term holders are just increasing and increasing over this period. Now, with recent proliferation of alt L1s, the marketplace for L1s has become saturated. leading many in the crypto community to question the need for additional block space. In our view, this supports the fundamental narrative for Ethereum as the leader in a multi-chain world, and we believe user and developer activity will aggregate to a small number of chains in 2023 compared to 2022. There are other competitors here to Ethereum, although Ethereum is clearly the leader. And part of what happened in 2021 and 2 was this alt L1 thesis. And really it was because there were so many people that flocked into the crypto ecosystem. Fees on ETH were like $50 to send ETH. And if you wanted to mint an NFT, a couple of $100. Now that prices out normal people. And so that is why you saw this alt L1, competition thrive. But the thing is that ETH is now scaled. You have Optimism and Arbitrum, and you also have Polygon that is moving over to L2 rather than just as a sidechain. And so it really begs the question, there's just no need for alt L1s because the scale is there on Ethereum, and that's where most of the liquidity and applications are. And so I do believe there are other ways for alt L1s to actually carve out a piece of the market for sure, but Ethereum is obviously the leader, and I don't see that changing anytime soon. The movement towards self-custody and DeFi will likely accelerate after the developments of FTX essentially and all of the proof of reserve stuff. So as you can see, DeFi is great, and it's going to be great for some people, but not for everyone. A lot of people do like to have a trusted counterparty with customer service. But there can be, I think, a CeFi DeFi mix where your assets potentially are held on chain and you have a little bit more security there, or just using DeFi to kind of prove that assets are held for you and not being spent on stadium naming rights and everything like that. Overall activity in DeFi retreated from a peak of 180 billion to 42 billion. This has been a disaster for DeFi for sure, and the first time that DeFi has ever had to deal with essentially higher yields in treasury markets. This is DeFi TVL versus 3-month T-bills. Now, 3-month T-bills in the States are yielding, 4.6%. And so when you have 3-month T-bills yielding 4.5%, and then you go over to DeFi, and you've got the risks of DeFi and smart contract risks, and you maybe have dollars on there yielding 3%, maybe 2.5%. Why would you put your money there versus doing it in T-bills? I think this is generally a correlation though as well with just a bear market, and there's less going on, less yield for those stable coins, and essentially everything came down 65% in value as well. So TVL is going to come down. Important to know though that crypto isn't going away. As you can see here, SocGen. We also have JP Morgan, DBS, SBI Digital. They have used DeFi. They have used public blockchains to issue assets. Very, very small for now, but it is showing us the way forward, which is these guys are going to continue to use public blockchains to actually issue assets on. Just to end this section as well, they touch on the use case for NFTs. I think NFTs are very useful, but the investment that you should make is in the public blockchain that the NFTs are issued on. The way that smart contract chains work is that they charge a fee, and some of that fee is passed back to you as an investor. Okay, so it's like a business that charges a fee for something, and then if you invest in equity, the whole point of investing in an equity is that you're buying a future cash flow. And so the cash flow of a smart contracts blockchain is to charge fees for something, and then a portion of those fees are used to pay you dividends. Another portion of those fees are used to buy and burn back tokens in the same way as a stock does a share buyback, lifting up the valuation of that thing you're invested in. I do not believe buying monkey JPEGs and all that nonsense is actually investment. You can collect that stuff and that's great, but if you're an investor, you're looking at buying future cash flows. Bitcoin is different. It's a store of value. It's extremely different, but a smart contracts chain has to have some sort of yield. If you value ETH versus Matic versus BNB versus ADA, how are they going to be valued over time? They'll be valued on yield differentials. How much yield can you get from them versus the other one? And the one that pays the most yield, i.e. is used by the most people, is going to be the most valuable. Very simple in my opinion. These are just modern digital businesses that are charging for that public secured block space. So in terms of NFTs, Collectibles, not interested in them, but ticketing, memberships, subscriptions, and tokenization of real world assets. That's a massive use case. So for example, if you have a ticketing system like Ticketmaster, and it's actually on the blockchain itself, and they are paying a fee for every transaction, you have a secondary market of tickets on Uniswap. People are trading those. Maybe they bought a ticket to the Super Bowl and they want to trade that out because they're going to flip it out. Each one of those transaction fees flows eventually to Uniswap, which is an actual investment with cash flows, and that flows down to Ethereum or Matic, whatever chain it's on, which is just slowly burning fees and paying you an investment yield. So these are very big, but I believe the actual investment to be made is in the exchanges as businesses or in the L1 protocols as businesses. This section is on Bitcoin, showing us that it's just a normal bear market. So I want to highlight this actually, because I think it's quite funny. On the bottom hand side here, we have all of essentially what is the garbage in crypto. And then on the top, you have the world's largest institutions getting into this technology. So we have ConocoPhillips, one of the biggest oil and gas miners in the world, announcing a BTC mining project. We have Exxon, again, one of the biggest oil and gas producers in the world, announcing a Bitcoin mining project. Really important. Remember all those people back, when crypto was popping off and they were saying, we don't like Bitcoin, it's too risky, we can't value it, we're going to get some stocks in mining companies. They've all gone bust. The reason is that if you're a mining company that went public during the bull market and you basically leveraged up your balance sheet, that's what you did, right? You tried to leverage up by selling equity and also taking 0% interest loans, because that's what it was back then. You've leveraged up your Bitcoin mining, Bitcoin falls in price, you're stuffed, right? Because now interest rates are higher. The problem is with Bitcoin miners is that if they pay for energy, they will eventually go to zero, because you have ConocoPhillips, you have Exxon, you also have Russia, literally Russia, that is mining Bitcoin now, right? Their marginal cost of energy is zero, because they are doing fracking, they are doing flaring, which is literally letting gas out for free, right? So you've taken it out the ground and you're just going to waste it. Their marginal cost of energy is zero. And so if you're a miner who's having to pay for energy, you are not competitive. And so that's why I believe that the largest institutions in the world, multinational corporations and countries themselves, will be the only miners, given enough time. We also have Strike right here. We also have Shell. So Shell, Exxon, ConocoPhillips. We also have Coinbase and BlackRock launching the Bitcoin private trust there to give institutional investors some exposure to BTC. On the bottom hand side, you had all of the garbage within crypto: FTX, Grayscale, 3AC, Terra Luna, all that garbage taking us down, which was individual. And so that is really short-term stuff that brings the price down, where I think that Conoco, Exxon, and Shell are probably long-term very, very good for Bitcoin. A very interesting point here as well from Coinbase is that this year, even though Bitcoin has fallen off against the dollar, because that's what we value it in, you can see here, in 2022, when all markets tended to be risk off, BTC actually outperformed most G10 FX pairs to the downside, except during May, June, and November. May, June, and November were specific events within crypto, with crypto native companies blowing up, right? 3AC, Celsius, BlockFi, and FTX. Now, those are short term, right? They're not systemic. They are not something wrong with the technology. And of course, we sold off more during those events. But during the other times, Bitcoin actually outperformed other currencies. And so you can see those events here with the underperformance down here, and then the FTX disaster on the right-hand side. But elsewhere, in normal markets, you can see actually it's quite strong versus other currencies against the dollar. So very interesting to see that. This also shows us that this is a normal bear market for BTC. The percentage of Bitcoin holders currently underwater is nearing 50%, just below the historical cycle highs reached in 2011 and 2015 and 2019, together averaging around 53%. These represent major inflection points for BTC performance, as you can see here. So in other videos, you might have seen me going over the MVRV score and many other on-chain ways of looking at cycles. And we're at the bottom of the cycle. It's very, very clear. It can be there for a long time. The price itself can go lower, but in terms of Bitcoin cycles, we are, right where we ought to be, and right where we are in many other cycles as well. Also, while the drop in BTC has been nearly commensurate with historical cycles, the state of play has shifted dramatically. In 2018, the Lightning Network was basically non-existent, and today the Lightning Network channel capacity hits all-time highs. Now, what is the Lightning Network? It's essentially a scaling layer on top of Bitcoin, trying to make it faster, and that's where you're going to get the next, lot of users. Developing countries find it very difficult to use the Bitcoin network, paying maybe $3-4 in a transaction. It's not great. Put it on the Lightning Network, that goes down to 0, and you have instant settlement. So going from 10-minute block time and paying like $4 or $5, whatever it is, to instant and free. That's a massive, massive use case, and it can help Bitcoin for sure, start a new bull market in terms of, the amount of growth, right? The speed of growth of the blockchain. And as you can see here, much of the future adoption of BTC, particularly in developing countries, may be driven by the asset's utility as a medium of exchange. I don't really agree with this. I think dollars are a medium of exchange. There's work to actually issue stablecoins on Bitcoin on the Lightning Network, which I think will really work. So you have free and instant settlement of dollars, which is, I think, really, really important for a lot of people that don't have bank accounts and other reasons. But Bitcoin being a store of value. Now, if you can transfer Bitcoin for free instantly, that's another great use case to actually have people store some of their wealth in BTC rather than having to use the base layer, which can be expensive. Despite this, though, as you can see, ETH is miles ahead. Public node capacity in US dollar terms on Bitcoin is less than 100 million, and on Ethereum it's 24 billion. So massive use case for ETH in terms of trade and settlement, as we know in DeFi. But BTC bringing that on, I think, will give it a major boost. They also discuss Ethereum, which is one of their top picks for obvious reasons. As you can see here, it has performed better than Solana, Avalanche, and Phantom, and many other chains as well. The reason being is that Ethereum and BNB chain, they have a lot of users now, and there's actually a way to fundamentally value them, right? They don't really have any token inflation anymore. They actually make profits as a protocol, and they pass some of those profits back to users. And so there's fundamental value in that sense, whereas other chains are still much earlier in their cycles, right? So, this happened to ETH in the last cycle, and it's now a lot stronger now. Each cycle, it just will get stronger and stronger, but the returns to the upside also will diminish. It's just maturity of an asset. Moreover, even though usage of new launches has slowed, we saw activity was enough to meet the ETH burn threshold. So I won't go over that, but essentially ETH is burned with every transaction, and it's actually at the moment flipping between being slightly inflationary and slightly deflationary. And so even during a bear market, it's basically no ETH issuance. During a bull market, ETH issuance will drop dramatically. Essentially, the protocol will be buying up tokens. So during a bull market, you would expect really good value to accrue to that token. As we can see here, investors are concerned that once staked ETH withdrawals are enabled, that could potentially flood the market with sellers. So I think around March next year, it looks like the Shanghai upgrade will take place, which enables ETH stakers to withdraw some of their ETH. Now, some will definitely sell, but a majority won't. Actually, most ETH that's staked is staked using liquid staking protocols anyway, right? So there are a lot of institutions that are staking ETH. That's one thing. The second thing is a lot of retail investors that have staked ETH have done it through Coinbase or Binance or Lido, and they're liquid staking protocols. That means that you can actually trade out of it if you want anyway. And so I don't think there's going to be a massive dump of ETH during that time. There will be some though. And so it's something to watch out for, where around March next year, if the Shanghai upgrade actually happens, there might be some chop and trade around that for sure. So it might be a tradable event anyway. As you can see, ETH has a bunch of upgrades coming that's going to take a very long time right here. Each of them just makes ETH more scalable. As you can see, they're looking to achieve around 100,000 transactions per second, given all the scaling layers as well, which is incredible and probably good for a while to come. Let's look at the L2 landscape then, because Optimism and Arbitrum have launched on top of ETH. And that's really bad news for the Alt L1 crowd, because the reason people didn't use ETH is because Avalanche and Solana were cheaper. Now they gave up a lot as well, but now you have Arbitrum and Optimism, which are directly on Ethereum. You can, bridge the tokens. There's good support and they're cheap. And you have the Ethereum apps. So there are currently around 140 smart contract blockchains and roll-ups being monitored by DeFi Llama. Ethereum accounts for 57% of total value locked. That's not a great metric, and it's not the only metric to look at, but we can compare. That share is unchanged from the end of last year, albeit down from Ethereum's almost 70% dominance in mid-2021. TVL data suggests that activity has been drifting away from Alt L1s like Avalanche and Solana in favor of Tron and Ethereum, and then Polygon, Arbitrum, Optimism, which are those really three solutions. Polygon is still proof of stake. It's like a sidechain, but the ZK EVM is coming, which is going to be developed right on Ethereum. And anyone developing apps on Polygon proof of stake right now will have a way of upgrading those over to ETH L2 Polygon ZK EVM. So that's why so many people are using Polygon specifically as well. Separately, BNB Smart Chain, BNB Chain has been able to maintain its share around 13%. So as you can see, the TVL charts right here, Ethereum still got that TVL right there at 57%. Now, what will happen, right, with Optimism and Arbitrum, they will take a lot of transactions away from Ethereum and maybe take a lot of TVL away from Ethereum. But I still value that as Ethereum TVL and Ethereum transactions. After all, they're a scaling solution on the layer one, the Ethereum blockchain, and essentially all of that value and transactions and everything eventually feeds down to Ethereum as the L1, accruing value and charging those fees for security. And so I believe that, as you can see here, with 2022, you can see Optimism and Arbitrum are just ticking up, right? And they were a lot lower back in 2021, but that's basically Ethereum. So you have Ethereum, Polygon, Arbitrum, Optimism, which I would all kind of class as the same Ethereum investment. Polygon's a little bit different because it's kind of a big suite of different solutions, but they're definitely Ethereum ecosystem. And then you have, BNB Chain, which is just totally different. It's, like an offshoot of the Binance Exchange, where some people can use applications directly within the Binance Exchange, but you can actually open a DeFi wallet within your Binance app. So there's a lot of use cases there, way more for retail users, especially outside of the States, whereas Ethereum, you can see, really is the kind of institutional choice right here, especially within the States as well. As you can see here as well, this chart's really interesting, that it essentially shows us that we're in a very young market. It's not very mature right now. And Coinbase, see here, it's less obvious whether this will become a winner-take-all market. So what you can see here is Arbitrum and Optimism taking TVL from everyone, right? Because people are saying, well, if Arbitrum and Optimism are basically an L2 on Ethereum, that's where we want to be, and TVL is flocking towards those. Now, Optimism actually had an incentive program this year as well, basically paying some OP tokens out to people on Aave and other applications. So they were incentivizing money to come over. What this shows me is that for right now, users are comfortable with BNB Chain. They're comfortable with Ethereum, Tron, Polygon, Arbitrum, and Optimism, right? They're comfortable with all these chains. They have enough trust where people can use them into, from one to the other, and they're just going to go to the chain that gives them incentives, right? And when all of that is eventually out, when these mature players eventually just have the market and no one can compete, this will be a little bit different. But for now, it shows you that who's investing in crypto now will go to the chain that gives them incentives, but you need more than that to actually, keep them there. There was a lot of financial alchemy in the bull market in 2020, 2021, trying to break the laws of physics. Luna is a good example of that. But I think the reality is that, crypto is just a technology that can make what we already know and use to be better. So we need a store of value, and Bitcoin is the apex asset. We need a means of exchange, which looks to be dollars. Most people prefer that as a means of exchange rather than something like Bitcoin. And there are investments you can make in crypto as well. but they need some sort of value accrual method, because if we just accept that Bitcoin is money and a store of value and everything else just isn't, it's different, they have to have a fundamental value accrual method where cash flows flow into the investment that you're making. And if they don't, I just don't think that they can ever have more than speculative value, which, as we know, just gets destroyed during a bear market and never comes back. And so that's my very simple framework for crypto: is you need a store of value, you need a means of payment, and that means of payment can be used on other chains that may also have NFTs and other use cases that can accrue some sort of value from charging fees. That's how I see things. In terms of how a lot of the institutions answered this survey from Coinbase, they see that 2023 essentially will be range bound and, a consolidation year in general, not the start of a new bull market. That makes sense. I think 2023 in general, with other markets as well, will just be a year of trying to get back to some sort of normality, finding a bottom and finding out how bad the recession is. But definitely won't be the start of some raging new bull market, because that's just not what central banks want. And so, as you can see here, like literally 80 to 90%, just think it will either be range bound or kind of trend lower. And I agree with that for the most part, and probably another good year to dollar cost average. Check the links in the description if you are an investor to get those deposit and trading bonuses. I'm James with MoneyZG. Cheers for watching, and I'll see you in the next one.